Do you ever wonder how the rich protect their wealth and grow it at the same time? Well, today I'm joined with Frank, and we're going to talk about a financial tool, a financial vehicle that the wealthy use to do just that. I appreciate you being here, Frank. Today we're going to be talking about the indexed universal life insurance policy and how we can use that to not only protect our assets, protect our money, but allow it to compound and grow over time. Correct?
That is correct. You got it, Nathaniel.
Awesome, man. I appreciate you being here. This is something that we've been looking heavily at lately and, wanting to use the tools that the wealthy use to protect and grow their assets. So, would you just kind of basic give me a rundown of what an IUL is?
Yeah, absolutely. So IUL is a form of an insurance contract. Um, to back it up to insurance, there's two types of insurance in this space. There's term insurance that could be an insurance policy that you get for 5, 10, 15, 20 years, even 30 years. And at the end of that term, the cost of that insurance goes up. So people don't usually keep their term policies past the term date. And then you have on the other side, you have permanent life insurance. That could be whole life or IUL, Index Universal Life. And that's basically permanent insurance that has flexible premiums as opposed to term insurance where you have a fixed premium for month to month or pay quarterly or yearly.
Okay. Yeah, so term it's essentially locking in my rate from what I'm gathering here. I'm 40. I'm going to have a lower rate than if I was starting it at 50.
That is correct. Absolutely.
Okay.
Yeah. It's all
Well,
about insurability and the risk to the insurance carrier.
okay. Is there like a maximum term that insurance companies will allow? Because my thinking is like I'm 30 years old. I just make a 100-year policy.
Yeah, it doesn't quite work like that, but we'd like it to, right?
Yeah.
But the maximum is about 30 years.
Okay.
So 30, so if you're 30 years old, 30-year policy puts you out to 60. And then at that point, you have the choice of, you could do another term policy at that point, but you're going to pay a higher cost, or you let go of your term policy that you have in force.
Gotcha. Okay. So we're not talking about term today, though, correct? We're talking about the IUL, and you mentioned it sounded like you said or indexed universal life insurance policy or whole life. I thought that those were kind of interchangeable as far as terms go, but it sounds like that's not the case.
No, they're different types of permanent policies.
What is the difference between the two?
Yeah, so the difference they run on the same chassis as far as universal life, but the biggest difference between whole life and IUL is with whole life, you've got guaranteed dividends. So say your whole life policy would pay out 5% dividends every year. The difference between that and an IUL is there are no guarantees with IUL, but you get an opportunity to make more of the upside on the IUL. So as an example, um, that while in the whole life, you may be getting 5% dividend in indexed universal life in the IUL, you would be getting maybe 10% because that index strategy in the IUL is linked to the S&P 500.
Okay. And now, okay, so I have some misconceptions already from what you're telling me. Is there truth to in the IUL that there is essentially no negative downside? You are capped at 0% if the S&P were to like tank.
That's correct. Yeah. So as an example, in the years that the S&P 500 really dropped, folks that were in IUL had a 0% floor. So they didn't lose any money in their IULs due to market risk. And it's actually the same with whole life. The only areas where you would see really that market risk is things like variable universal life or VUL, where it's actually participating in the market.
Gotcha. Okay, so now it's making a little bit more sense what the name is. It's it's almost like an index that you could just go buy on the stock, on the stock exchange, kind of that tracks the whatever the S&P or oh man, I'm losing what the other one is, but the other ones are the S&P and the well, whatever. Doesn't matter. That's not what I'm talking about. So
NASDAQ, yeah, down.
there you go. Yeah. When somebody buys an IUL, I'm still paying a monthly premium. How does that kind of work compared to the term policy? Because I think that's what most people are probably familiar with is like life insurance. You pay $50 a month for 30 years, you get a $500,000 benefit. I just made up numbers there, but just to kind of illustrate the point. Is that the same? Is it like a set kind of is a set monthly payment with the IUL?
Yeah, I'll give you a couple of examples. So with the term insurance, say you're 30 years old, you're paying $50 a month for, say, $1 million of death benefit for 30 years. So $50 a month. You're not getting any of that premium that you're putting in. You're basically renting insurance at that
Hmm.
point.
Yeah.
So you're paying $50 a month for 30 years. You don't get any of that back. The difference in an IUL is say you've got that same 30-year-old, $1 million death benefit, but say you're able to put in $200 a month into the IUL. There's a cost of insurance for that $1 million of death benefit that you're paying. Say that of that $200 that you're paying in, we'll keep the numbers easy and say 50 of that is paying for the cost of that death benefit. The
Okay.
other 150 is going into what we call cash value in that permanent policy. And that cash value is growing over time. It's linked to different indexes like we talked about. So say the S&P 500. So as the account is growing, that cash value continues to grow, continues to compound. You have your years where you have 0% credited to your account because the market may have tanked, but in the good years, you're gaining on that cash value. So over time, that's where you see the growth in the policy.
Yeah. So uh, what is the point of the cash value? What do I do with this? Is that yeah, it seems like why the heck would I do term? Um, but yeah, what's the point of the cash value for me?
Right. Right. Well, so I get that question, I get that question often. So the point with term, you're getting a death benefit, right? You're getting, in both cases, you're getting a death benefit. With term, there's obviously cheaper cost to that death benefit, right?
Okay.
But for people that want to be able to put their money somewhere where they have the opportunity to grow that money at a better rate of return than, say, a savings account, then the IUL is a great option for people. I see it as personally, my opinion is it's one of the strongest foundations for a reserve account. And I'm also a real estate investor and do different things in that space. And to be able to have that cash value that's building that I can actually borrow against, that's something we haven't talked about yet. I can borrow against that cash value to go ahead and invest in some of my favorite investments like real estate or other businesses. That's very powerful.
Yeah, so the cash value as it's growing over time, we can start to utilize it for other purposes, or we could just leave it there. If we were to just leave it in place, you mentioned we're paying 200 in this example, 50 of it is getting put towards that insurance. The 150 is starting to grow over time. Let's say after 10 years it's grown now. What? We can use it to go invest, or can we just take it and go, hey, it's our cash now.
Yeah, yeah. Great question. As soon as that cash value starts building, and we designed these policies in different ways and actually very efficient. As long as it's structured and designed efficiently and funded, it's very important that it's funded efficiently. Once your cash value starts growing, you mentioned 10 years, but we've seen models where there's cash value as early as year two. You're able to basically call up the insurance company and say, hey, I want to take out what we call a policy loan against my cash value. And the insurance company will, within a week or so, send you that money, and that's yours. It's basically your cash sitting in the policy that you can leverage against. Now, there's a cost to doing that. There's two different ways of pulling money out of your policy. You can withdraw it, or you can take policy loans.
Okay.
And we typically educate people on the latter because what the difference is when you're withdrawing the cash from the policy, say you have cash value over time of $100,000 of cash in your policy. If you want to withdraw $50,000, now there's only $50,000 left in your policy that's earning in the policy. But when you take a policy loan of $50,000, that $100,000 is still earning, but now you have a loan for $50,000 at a cost, but it's typically what we see right now is it's a lower cost for that loan than you would get at a bank for that
Okay.
50,000. So you're basically having your money work in two different places at the same time.
Yeah. That's where it seems like that's where the power comes in to this IUL policy is allowing it to build up. Maybe you can't do it in 2 years, but maybe it takes you five. But at year five, you're able to kind of leverage it and have your money working in two ways. I, I don't want to get too in the weeds here. I wanted this to be very just kind of like a basic foundational of what this is. I am wondering, as far as the cash value side of things go, and being able to take that policy loan out, is that the same concept for the whole life versus the IUL, where the whole life is just gaining that, you said, 5% steadily, it doesn't have any up or downside. Does that kind of work the same between the two?
Yeah, as far as taking out policy loans from the policy for income or other investments, if you choose, it's the same concept. And we usually have I'll call it a debate about this. Is whole life better? Is IUL better? Both have their advantages. The way I look at it is I personally, use my IUL the way we're explaining. And if I had a whole life policy, if there's a guaranteed dividend, I give this example. If there's a guaranteed dividend of say 5%, 5.5%, and that's the growth on my funds. If I want to borrow against that cash value at say 5%, then there's not much wiggle room for our positive arbitrage there for
Mm,
my money to be making money over time. In the IUL, it's not guaranteed, but I do have the potential for the higher returns. So the higher returns is what I've looked at. The higher returns allows for that positive arbitrage to where I can leverage against it at 5% cost. And then there's a spread where my money can continue to make money. So that's
okay.
why I lean more towards the IUL.
Okay. Yeah, and that makes sense. Like you could see, oh, the stock market's doing really well. It's making 12% returns. I'm going to take it out at 6%. I get that that 6% delta in there. Does the does the policy loan rate change over time? I'm thinking like as the Fed does their thing, or is that like something that's fixed when you come to the policy?
Yeah, great question. So every carrier is different. We do an analysis of a lot of the carriers out there for IUL. So on a monthly basis, we're looking at these different things. But so for example, our top IUL out there, their contract says that the policy loan rate can range from 5% to 8%, right?
Okay.
But in the history of that, we've seen 5% consistently. So it can change in that example. They could go up as high as 8%, but it hasn't changed from 5% since
Okay.
the history of that IUL.
Interesting. It seems like there's a lot of advantages here. It's something that you need to kind of foreshadow or forethink about. Like, hey, a couple years down the line is when I'm
Oh,
really going to be able to take advantage of this. So, like, setting aside money now, is there like is there a percentage of income that you recommend people put in, or don't exceed this, do a minimum of this? Like, what's that kind of look like?
yeah, that's a great question. So it really depends.
Yeah.
It depends on the financial position of the client. You know, we work with high net worth folks. We work with folks that make an average income, and it really does depend. We do an analysis and look at what their financial picture looks like, and we design from there. You know, we have a very good planning process that we go through. Look at all the assets, the liabilities, what's really going on, and then what the goals are for the client. And from that point, we figure out, okay, what makes sense? How do we use the IUL, if we do use it, as a potential tool for them to grow their wealth or for whatever their goals are? You know?
Yeah. Okay. And now, as the term life insurance policy is a fixed number. We just said $50 a month, just for numbers purposes. Is the IUL or the whole life, are those fixed as well, or do I just decide, hey, this month I want to put $500 in, maybe next month I only want to put $150 in? How does that kind of play out?
Yeah, it's very flexible in that sense. So say I look at things from a yearly basis. So say an IUL was designed to put in $12,000 a year, so $1,000 a month. Someone can be going along putting that $1,000 a month. They could put 500 a month at one point, you know. But and the reason they're able to do that is we design these policies. This gets a little bit technical, but I just want to point this out. We design it to be the minimum death benefit for the maximum amount of cash value accumulation. So we design it very efficiently so that the funds that they're able to put in to keep that policy tax free, which is a huge advantage, they are flexible in the way they do that. If somebody's putting in 1,000 a month, say that first year they put in the full 12,000. Next year they could put in 6,000. Policy would still be okay, and they
Okay.
can also catch up in future. So if they didn't put in the full 12,000 year two, they can catch up that premium in year three, and so it's very flexible in that sense.
Okay. It sounds like there is a minimum that you need to put in to keep your life insurance side of things guaranteed. Is that correct?
Correct. Correct.
Okay.
Yeah. And in the example I just gave, if the maximum premium they can put in is 12,000 or 1,000 a month, the minimum could be 100 a month in that example. So because they're putting in 1,000, they're front loading that policy, keeping it within IRS guidelines to keep it tax free, and
Okay.
then they're able to be for the future with their premiums.
Yeah, see, now you've mentioned it twice now, and we haven't even talked about the tax benefits of things. I wanted to keep this really short and sweet, just for people getting introduced to this. But would you, as kind of close us out with the tax benefits of this insurance policy, this vehicle?
Absolutely, yeah, and it's one of my favorite topics, so I look forward to talking about it more if we have to. So as long as a policy is designed properly, there is IRS code that backs this up. The growth in the policy and the distributions to heirs at death or while you're living when you're taking, policy loans, all of that is tax free. So it's a very, very huge benefit to IUL, but it really, really hinges on structuring the policy properly, not putting in more than you can for the death benefit that you're applying for. And yeah, there's a lot to it, but it's we can dig in more of that next time.
Yeah. Is there anything that, like, from an introductory standpoint that we may have missed, Frank, that maybe I didn't ask a question about?
No, I mean the fundamentals of IUL are that there you have what I like to educate on is you have a form of liquidity. It's safe, depending on the carrier, and we do that analysis. So you have a safe company with good credit risk, and no default risk, no credit risk. You have a rate of return and high potential in most cases, and you have your tax favorability. So those are the fundamentals of IUL, and yeah.
Awesome. Yeah, well, I appreciate you. If you're out there listening and you found value in this, please drop a comment below so we know that you're interested. Frank has opened himself up to, talking a part two. I'm thinking maybe we could do like a whiteboard and we can walk through what some of this stuff would look like. But we're only going to do that if you guys have found value in what Frank is talking about here. How do people get a hold of you, Frank, if they're interested in just coming directly and maybe learning more from you and maybe getting something set up?
Yeah, absolutely. You can certainly email me. I can drop my email, get it over to you, Nathaniel. And yeah, I'm happy to connect. And we talk to people every day. We're education based, so yeah, anytime, we're more than happy to.
Awesome. Yeah, I'll make sure that the email gets in the description below. So if you're watching and you just want to reach right out to Frank, send him an email and get hooked up. I appreciate you for being here. Hopefully we can do a part two on this.
Thanks, Nathaniel. Great talking to you.